Hi, everyone. Thanks for being here. We have a great panel, and I'm going to let everybody introduce themselves, each get 1 minute, and we will start with Bruce. This is in alphabetical order. So Bruce, then Scott, Rob, and from there will be Fuquan, Ken, Mike, and then Jake. This is alphabetical order by company name. So go ahead and start, Bruce.
Bruce, you need to unmute yourself.
Apologize, rookie error. I'm Bruce Fraser, managing partner of Elkhorn Capital Partners. I have a different background, I think, than most in real estate. Eco-finance degree undergrad and a master's in finance. I also ran a hedge fund for over a decade. We were actually at our all-time highs during the troughs of the great financial crisis. During the hedge fund years, I was also an active real estate investor, but due to my research in the fund, we sold all of our real estate holdings in 2007, and I formed Elkhorn, began buying again in 2010, 2011. Elkhorn is on the principal side and is exclusively focused on multifamily in the South and Midwest. Our assets generally fall within the workhorse housing segment. Over the years, we've developed a specialty in distressed situation acquisitions. That can be anything from management-driven assets that need strategic capital, or more currently, distress caused by the capital structure or partnership disputes. Our portfolio was all on fixed rate debt coming into the recent historic rate hikes, and so I think we're well positioned to be very active in acquisitions this year.
Thank you. Nice to meet you, Bruce.
All right,
well. Scott, it's your turn.
Great. Well, unlike Bruce, I know just about everybody on this call except for Bruce and Robert. So I guess I came up through the traditional route in terms of real estate. Started out in single-family houses, single-family rentals as a hedge to retirement back when I was working for AT&T, and then it just kind of took on a life of its own. And eventually quit my day job and began investing full-time in real estate. Got into multifamily, had a number of those complexes here in central Indiana, and really didn't like the tenant and toilet and trash business that we found ourselves in as we continued to grow in scale. And we also didn't like the ups and downs of the valuations of a multifamily. And so once I finally got over myself and decided to go what I felt was backwards in terms of real estate investing in these simple little metal boxes on concrete slabs, we found self-storage, invested in our first, and never looked back. And so we sold off everything else, and that's when we got really good at growing and scaling to raise private equity to do so, to be able to grow and scale. So a lot of private placements in the beginning, and then I moved into the fund model, and we've closed out 3 funds recently and just opened another one, a fourth, which is focusing on conversions right now. So buying industrial buildings and other types of asset classes that we can convert and repurpose into self-storage. So a number of different companies. Kingdom Storage is probably at the forefront. That is the GP that enters into almost all of these projects that we're involved in. We have a lot of one-off joint ventures in addition to our funds as well. And yeah, really, really bullish on the market right now. Love what we're seeing in self-storage, and don't see us, never say never, but don't see us going back to the other asset classes.
Well, thanks for being here. Rob, you're next.
All right. Thanks, Dana and Mike. Appreciate you hosting this. It's great. My name is Rob Levy, managing partner of LBX Investments. We primarily today invest in retail, mostly grocery anchored or the like, kind of outdoor, open air retail. We don't invest in anything kind of enclosed. My background is kind of all over the place. I've been in investment banking. I ran a publicly traded multifamily investment and finance company in New York, and which we took private. And so I've been in multifamily, I've been in lodging, I've been in retail. My partner, Phil, has been in other sectors. So we have pretty diverse backgrounds in real estate. And when we started the company 8 years ago, decided we felt that retail was a misunderstood, unloved sector of the real estate world, and we felt therefore there was opportunity to buy real estate at attractive yields and create value for our investors and ourselves. It's the vast 8 years we've been investing in retail, and that has worked out well for us. So anyway, we'll talk more about retail, but that's kind of my background and LBX.
Awesome. Okay, Fuquan.
Hello, can you hear me? Awesome.
Yes, we can.
Yeah, so Fuquan Bilal, NNG Capital Fund. Let's see, been in real estate since 99. Yeah, 99. Jumped out the window and grew wings falling down in 99, as they say. So started off with fix and flips in New Jersey. Primarily do stuff that's maybe 25 to 30 minutes away from New York City. Pretty much after the GFC, started to get into the note business. Like Scott, didn't want to deal with the tenants' tallest trash and termites, and got into the paper business, ran a few funds buying and selling mortgage notes, somewhere around 2017, 2018, created a more diversified model where we infused fix and flips with notes. And today we have a diversified model where we run a fund where we buy paper from the banks as well as do some fix and flips in New Jersey and have rentals in there. So it's like a hybrid, a buffer hedge against market uncertainty. What we're really focusing on now is multifamily and fix and flips. The no business is good, is not great. So for us, we're focusing on things that we have more control over. The no business is quite litigious, but we're seeing a lot of opportunities in the multifamily sector and luxury fix and flip. So we're located in New Jersey. We have about a 25 person team. And I'm happy to be here. Thanks for inviting us, and ready to get into the topic and learn more.
Yeah, we're
I'm
excited
actually
to
here
have
to
you.
learn. I'm here to be a student.
Well, we want to hear from you and learn from you too. Mike, you're next.
Thank you all for joining. Really appreciate many of you are close friends, and I'm grateful. And some are new relationship, like Bruce. We're really happy to have you and respond on short notice as another person who couldn't make it. So thank you, Bruce, for joining us, and thank you all, Rob, Ken, Scott, Jake, Fuquan. So Big Mike Zlotnik, Tampa Family of Funds. I've been so sort of short version of my career. 15 years technology career, started investing passively in real estate in New York City in 2000. 2009 went full time. Tampa Family of Funds started then, and we've done quite a bit of financing during the great financial crisis, financed short sale flips. Then it went into various forms of hard money lending, and then expanded into various commercial real estate strategies. Our model is sort of a fund-to-fund model. So we invest with many of you guys, many of strategies that make sense. So we basically look for the best of breed operators who are specialists in their niche, and then write a check or multiple checks with the people who we know, like, and trust. And that's what Temple Family of Funds and Syndications is all about. Just working with the best operators in whatever strategy, diversifying as a key element of what we do. And we continue to evolve with times. Obviously, we're dealing with very unprecedented market conditions now. So we're looking for fresh opportunities in this environment, but that'll follow. So again, thank you all for joining.
Great. I'm actually Deanna, part of Big Mike's team. So if you don't know me, just letting you know, that's why I have this background up. But Ken, it's your turn.
Yes, thanks for having me, Mike and Deanna and everyone. It's great to meet everyone. I'm Ken Majmudar. I'm the founder of Ridgewood Investments. We're a 21-year-old investment management firm set up like a multifamily office. We actually advise clients on a bunch of different types of investments. So we have a very significant investment pool for the stock market and through investment funds, and then a significant part in real estate, which, similarly to Mike, we sometimes in the past partnered with best-in-class operators. And we've also done some debt, hard money, mezzanine lending. And recently we've partnered with a few people to do ground-up build-to-rent development as well. So that's me.
Thank you. Thank you for being here. It was nice to see you recently in California. Jake, it's your turn.
The best for last. Mike, Deanna, thanks for hosting us all. Happy Friday, everybody. I'm Jake Vanderslice. I'm a principal at VanWest Partners. My evolution is not unlike Scott Meyers. We got into real estate investing full time in 2006. We did a lot of single family fix and flips, multifamily, adaptive reuse retail. And we got into self-storage in about 2015. And it wasn't really an intentional pivot to a full new strategy. It was more like, let's try a deal out and see how it goes. And it went okay. We did some more. So we launched our first fund in 19, our second fund in 21, and we're currently closing out our third fund. We've got 38 facilities, just over 18,000 units in 13 different states. And we generally target inefficiently operated value add storage acquisitions, sellers that don't have efficient revenue management in place. Their advertising isn't great. And we self-manage. So most of our value proposition is just optimizing the performance of the facility by leveraging our management platform. So that's what we're up to. Happy to be here. And thank you again for asking us to attend.
Awesome. Well, I'm glad you all made it. Thank you for attending the 2024 Real Estate Insights. We're actually planning to do one later on this year again to see how things have changed in the market. And I invite everyone to ask their questions in the chat, and we will get to them later on after we've talked on several topics. We're going to talk about navigating the economic trends and investment opportunities across all these different sectors in the entire United States. And so I'm going to pose the first question. And the question is, considering the current economic indicators, what major trends do you foresee impacting the real estate market in 2024? How should investors adapt to these trends? Is there anyone who wants to volunteer to go first?
I'll jump in.
Awesome.
I guess everybody else here knows each other, I guess. I'm the new kid. But, you know, like I mentioned, real estate and multifamily specifically is a strategic investment allocation decision for us. We didn't just kind of grow into it. And the reason we're so focused on it is our long-term inflation trend. We spend a lot of time digging into the numbers and the government debt numbers, and I post about it every now and then. But it's to the point where we have to, any logical person that is doing the math has to assume that the government's going to have to keep printing money in order to sustain its spending. And that, of course, is inflationary. And so that's why we're focused so much on real estate and taking this downturn as an opportunity to buy more.
That's awesome. I think that is in line with a lot of people right now.
Yeah, I'll jump in on that too. I was actually just having a conversation yesterday with an investor talking about, you know, macro and micro, right? Everything is market related. So we were talking about rents, right? And I was saying, hey, I don't do Class A, so I'm not seeing the same thing Class A multifamily operators are seeing in Class C plus, right? Especially if you purchase, and there's still room to grow rents, right? The goal is to buy things where you can increase the rents 26% from where they are, so you have an upgrowth, right? Versus going at the maximum amount at a Class A, where now things are starting to soften. So looking at the business model, looking at it more on a micro, will determine the trends and stuff that's going to happen in the future, right? And as Bruce said, that basically is your model, right? So it's all different. We're all in different types of the business. So what Scott or Jake may see in the storage thing may be different than what I see, but overall, it's the operator, the person who's driving the bus, that you're betting on, right? To be able to navigate the narrows.
Yeah, I can chime in a little bit. Certainly agree with what the guys said. The only thing I'll add is certainly inflation is having a significant impact on real estate investing today. Cost of construction is up significantly. Cost of operations, insurance in certain markets is extremely expensive, and for certain markets, almost impossible to get. Real estate taxes are climbing as local municipalities are trying to fill in budget gaps. So certainly some significant impact of operating costs, inflation, construction costs, et cetera. The only thing I'll add on top of that is financing. Not just equity, not just debt, but equity. I think liquidity in the markets is going to be really choppy in 2024, maybe after. What's the health of the banking system today? Do we need consolidation in the banking system? We're seeing bank lenders being very cautious in the market today. They are not getting a lot of money back from existing investments, and plus their balance sheets are somewhat upside down with the value of their portfolios. So we're seeing lack of liquidity in the debt markets, but then on the other hand, we're seeing a ton of equity kind of on the sidelines looking at real estate, which is making it pretty competitive in certain instances as we're bidding on deals. So a lot of moving pieces there. Inflation, capital markets, liquidity that I think are going to really impact 2024 and opportunities in our markets.
I don't have a whole lot to add on as far as our approach or what we're seeing that is different in the storage sector. The good news is that we've seen inflation level off. We certainly have higher construction costs, but that too has leveled off, which just makes it easier for us to be able to budget, especially when we're going into a development project, whether it be a ground up or conversion. But when it comes to acquisitions, as we just heard from Robert, there are some things that we do need to keep an eye on, and that is, insurance costs, especially if we're anywhere near a state in which the wind blows heavy from the ocean. In terms of hurricanes, we've seen the storage industry get hit perhaps a little harder than others. And these insurance companies have had to make up for the shortfall that that they have now in their coffers from a significant amount of events that have occurred that have emptied their coffers. And so we've seen, in some cases, a tripling of our insurance costs heading into a project. Some of those, thankfully not ours, but some of our folks have talked about this happening, in the midst of a contract, and has killed the deal. And so there's that. And then property taxes, which is always, you never know if there's going to be a change, who's going to come into office. And the assessor decides that, hey, here's a windfall. We haven't, the way that we've assessed taxes has been improper and not the same as our neighboring states. And so we're going to change things dramatically. And that is, from time to time, posed a little bit of a challenge to us. Outside of that, depending on who's listening and how you approach underwriting, our underwriting hasn't really changed. Our model hasn't changed. The inputs change. We look a little further down the road in these turbulent times with some of those factors that can, like a tripling of insurance or property taxes, we take that into consideration. But our model still has our yield and everything else built into it. It's just up to us to be able to flesh out, what are the inputs that have changed and that may potentially change to make sure that we still have a green light at the end of our financial analysis. So that's the way we're approaching the market. It's not going to be any slower for us. It's not going to be, we're not going to be going like gangbusters. There's no huge opportunities that we're seeing in 2024. It's just more steady activity and that we've seen from an extension of the end of last year.
Yeah, I mean, I think it's real. Oh, sorry, go ahead.
Yes, I was just going to add like three broader things to kind of monitor in 2024. First of all, obviously, interest rates went up quite a bit, and the Fed has leveled off their policy guidance if there's anticipation that perhaps interest rates will drop later this year. And if that does happen, obviously, that would provide a little bit of relief from the financing perspective. A second factor is the availability of lending relative to where it was a few years back with what's happened with some of the regional banks, including most recently. Banks have tightened up the LTVs, loan to value that folks are willing to lend is usually a little bit more tight. So you have to raise more equity. That affects the returns or sometimes mezz. So that's a second important factor. And a third one to throw into the mix is that in certain markets, I think in the South and Southwest, where there was a lot of construction, I think some of the markets, I guess, have tipped a little bit more into oversupply. I've heard of that also happening in storage. I'd be interested to hear folks' views on that. And so, you had a boom in the pandemic, and some of that, along with the inflation, the rents that were projected are not coming in where they were projected, maybe a little softer. So that's putting some stress on certain assets and certain owners, which will obviously also create opportunities. So those are three other additional things to keep an eye on for this year.
I think what I was going to say, just to simplify the inflation discussion, is first of all, CPI is they change that calculation all the time to help suppress the number, and so we look at other indicators as well. While the CPI has flattened out, we feel that inflation is running a good bit hotter than that. But in an inflationary environment, what you need to do is have a product that you can lock in today's dollars and rent out or have somebody utilize your product in the future in tomorrow's dollars. You have to lock in as many expenses as you can today and let the revenue climb. Now, that's a supply and demand factor comes into that, because you have to do the math or the research on what could affect my expenses. Being in Florida, for example, on the coast where hurricanes happen, even if they haven't happened in years, well, they could happen, and my insurance costs could triple, which is what a lot of people are experiencing. Houston, it's so easy to build in Houston that you can't get rent growth. So, you don't have that ability to offset the rising costs. And so a lot of people are struggling in Houston right now. That's somewhat predictable. Austin, great market. People love investing there, but people love investing there so much, everybody's building there. So supply is spiking, which dampens the ability, again, to raise pricing. And so we often are investing in areas that aren't fun. And people, it's not the hot dot, because there are opportunities there for rental growth that are substantial, because there is no supply or minimal supply. And so you have to, again, I'm economics by degree, but to me, if you're not thinking about the supply and demand mix when you're making these investments, it's going to be harmful.
Jake, I
Let
saw
me add a
you
couple
on-
of comments. Yeah,
Okay.
and then Jake, again, you go last. So I guess last but not least. So I'll just have a couple of comments here. A lot of great wisdom within the group. So again, higher for longer rates is here to stay. At least we're not seeing anything breaking in the economy. So we have to prepare for what Fed has been signaling for quite a while. It is impacting fundamentally solid asset classes from a financial side. So all the stuff discussed here, fundamental demand, obviously none of us is in the office space building. That asset class has been damaged. Multifamily storage, open air shopping, and industrial, a number of other fundamental real estate classes are doing well. Of course, adjustments for specific submarkets matter. Like Bruce, you said, some of these markets, Houston's, Austin's of the world, Atlanta's, Phoenix's, they've been oversupplied for multifamily, for example. There's some risk there. But in general, if you go to Midwest, where supply is much more slower growing and the demand is steady, of course, these markets present great opportunities. But from opportunity standpoint, what I do see in this environment, when rates spiked, Fed did what they didn't do in the past. They actually changed their approach fundamentally. In the past, whenever they acted, they usually hiked slow, cut fast. This time they hiked fast and cutting very slow. So we're dealing with this environment where many projects are simply running out of liquidity. Pressures from floating rate debt, variable rate mortgages, combine that with maturities cliff. Many projects need cash to survive, fundamentally solid projects, strong operators. So we see mass financing as a strong opportunity for 2024 to provide capital to strong operators on worthy projects, to get them to the finish line. Of course, that dilutes existing investors, but that also gets these projects an opportunity to survive and to thrive when they get to full stabilization and they can get sold in a better market. So for sure that. The deep buy comment, I'll just say this. Many of us are looking for great deals. So we want to buy deep. We're all looking for these wonderful, deeply discounted deals, but they're not yet happening in volume. So only the time will show. Some operators, financially strapped, will be forced to sell, sort of giving away the farm, and those opportunities may happen in some markets, although it's not happening in volume yet. So the immediate area of opportunity is to look at the existing projects, which ones are worthy, and consider providing some support in the form of mass financing. And that's the way to participate, at least from our point of view. We see as sort of an immediate opportunity in 2024, and then see what happens later part of the year.
Thanks, Mike. Go ahead, Jake. Do you have anything to add?
Well, all of our predictions are wrong, right? On this call, news articles. I've got a little habit of saving alarmist articles that will come out and then calendaring 6 months or a year down the road to see what actually happened. And one of them was July of 22, recession looming, richer shedding assets, cracks in the job market. That was July of 22, right? And predictions are wrong for the most part, but I'm going to call out Mike here. So December 1st of 2023, Big Mike called for the 10-year Treasury yield to be at 4.5% by the end of Q1. And I put it on my calendar for next week as a reminder. And Mike, it's a roughly 2.5 right now. So maybe not all the predictions are wrong, right? You might have called that one the right way. But we don't know what's going to
Yes,
happen.
how about that? Crystal ball worked for about 30 seconds. And
That's
I don't
right.
know
Yeah. What's the broke clock is right twice a day, right? But we don't know what's going to happen, right? And this inevitable soft landing we've been hearing about forever, is there even going to be a landing, right? And as Mike alluded to a moment ago, be careful what side of the coin you're on here when you make wishes like this. But I think all of us, to a degree on this call, have wished for some distress, right? As long as we're not in the distress and on the wrong side of the distress, we've all kind of, cautiously hoped for some devaluation and some acquisition opportunities. And despite the rise in interest rates and all the headlines you see, office is obviously different. We're not seeing that yet. We're seeing some micro distress for all the reasons Mike described. We're seeing some low maturity issues, operators who have a bridge loan, it's a lease up deal, they can't refinance it, they got a problem. So we're seeing micro one-off deal duress, but we're not seeing a macro devaluation. I think in any of the asset classes we're all looking at. So deal flow remains challenging. The bid ask is still wide, and I feel like I'm giving the same talk I gave a year ago. Deal flow is tough. The bid ask is wide. Well, not much has changed. And I don't know what that catalyst is going to be, if there even is one, to cause a big devaluation in real estate values outside of office. And briefly, to return to Deanna's question, the trend for 2024, what are the implications for investors? I would say the big implication for real estate investors for the next few quarters are you cannot expect a targeted return that was as high as your targeted returns and deals you might have done in 2021. They're just not out there anymore. So if someone was pitching a mid to high teens IRR in 21 and now they're pitching a 25 IRR, other than some special circumstances, you should be kind of scratching your head over those assumptions. And I think the two big reasons why those return targets have not certainly gone up. One is asset values are more or less the same as they were when debt was cheaper. I mean, that's a big statement to make. There's been some cap rate expansion. But secondly, deals are requiring a lot more equity now. So if you're implementing lower leverage in your project, let's say you were doing 65 or 70 before, and now you're doing 50, the fundamentals of the deal might still be the same, but the returns on that equity are going to be lower because of that increased equity and that decreased leverage. So I think for the rest of the year, certainly not a fearful approach, but a cautious approach to any deals that we might be doing is something we're thinking about a lot. And just given that lower leverage, which I think is temporary, I'm not sure how long temporary is, but we're not going to be at 50% leverage forever. But don't expect the stratospheric return targets you were seeing a couple of years ago. That's one big takeaway I would offer is returns are not what they used to be. Returns are still good, but they're not where they used to be.
One thing just to tag on to what Jacob and Mike just said about the distress, there's just tons of people waiting for the blood to be in the water and for all these deals to come flowing out. And I've seen that in multiple cycles. Big funds get created waiting for the washout, and sometimes the washout doesn't come. Either the Fed will respond and do something like they did in 08, and there wasn't really the washout that everybody expected. But so we're not waiting for a bottom. We're just kind of steadily buying through it. If there is a big decline, we'll buy more, but we don't want the Fed to start cutting it and having missed some of these opportunities. But what I would say is there is indirect, while it may not be a pending foreclosure or something like that, it's creating some trauma in the market, even so, because there are so many people struggling with problems in their own portfolios that there are a lot fewer buyers out there right now. And we just bought a really clean 100% classic deal, which normally dozens of people would have bid on, and there weren't any buyers out there for it. And so we got called to the table, even though that's not normally a deal we would have bid on. And so it's a reduction in buyers, and then also just the stress of the deal. It's causing partnership disputes. Now, the bank may not be taking the asset, but they're suing each other. And so there are opportunities out there, but they may not be the more traditional type that we're all kind of hoping and waiting for.
Thank you. I think we're going to move into different sectors specifically and talk on different trends that have been an issue since COVID. I want to start with multifamily. So if you could raise your hand if you do it multifamily investments. Mike, raise your hand. Okay, so let's start with Fuquan. With the evolving urban demographics and remote work trends, how do you see the demand for multifamily housing changing in 2024, and what are the implications for investors?
I mean, as far as from an investor standpoint, I think because of what's happening with a lot of the investors who haven't been able to execute on their plan, as we get further along down the path, we're going to see more assets becoming available, right? It was been very tough time for us to find a great deals. We had to kiss a lot of frogs, as I always say, to find that great deal in this market. I think that's going to get easier because the timeline is getting shorter. There's been a lot of investors who have been doing cash calls who haven't been successful, and they have to exit those deals. We've seen things go down in the last few months, 20, 25,000 a door in certain areas, right? Which is great, right? And we're still not jumping on that because just of price, right? Because could be something else wrong with it. But as the time goes, if interest rates doesn't drop and it's going to get tougher for them to refinance, that's where I think the opportunity is going to come from that. But I don't have a crystal ball. We don't know what's going to happen, but we're all looking forward to that. The same way we're looking forward to post-COVID. We thought it was going to be an abundance of opportunities falling out the sky, and things went the other way. It was like a dead cat bounce, and the market shot up. So, I believe that from the circles I'm in and the brokers that I'm speaking to, and some people who do lending at Marcus Millichap and had done a lot of these loans, there's rumblings about certain sponsors that are struggling. So I think that's where the majority of the opportunity is going to come from.
Who wants to go next? Mike, Ken, Bruce?
I'll
can go.
chime in. Oh,
Okay,
go
go ahead, Mike. No, I was just gonna, since we're talking about multifamily, so besides what I mentioned earlier about some markets, in a significant supply situation, I think Austin was discussed, and there's others. But longer term, so historically in the US, I think about 34 to 36% of people rent, and that's been relatively stable. There was a spike in 07, 08, 09. Now we've got a situation where mortgage rates are, at multi-decade highs. So home ownership is going to be more expensive, which will probably drive a little more demand for good rentals. So I think that the demand picture is there, and most of the issues that we're seeing are more related to specific deals, so either supply-demand imbalance or financing, capital structure kind of challenges. But the fundamentals of renting and the fundamental demand for rentals will continue, and particularly as a hangover from the last time when 07, 08, 09, 010, about a decade ago, the numbers that I've seen and something like 3 million housing units, there's a shortage. And then combined with one of the things that happens with the rates going up is that folks are staying put in their houses. So because if they have a low mortgage rate, they don't want to sell it, and it's so much more expensive to move. So with all of those dynamics, I think that there's going to be a relatively robust demand for good rentals that one could anticipate for quite some time to come. And the issue is not really on the overall strength of demand or the need for rental housing, but more so on these other local or financial factors.
I know it's definitely affected the migration patterns since COVID. It's why the South got popular, because the laws are different. People didn't have the rules they had in New York, and it's changed a lot of the markets that I'm familiar with. And so it's very interesting to me because those people are going away now, or they just can't afford to live there anymore. And I'm wondering where they're going. So great. Thanks for that information. Does anybody else want to put in any comment on multifamily?
I'll just have a couple of quick comments. So listening to the podcast episode, again, Ken, thanks for the referral for the podcast. I was talking about the builder, D.R. Horton, and how the supply of housing units in the United States is still significantly short. There's a lot more demand is growing based on population growth. And then there's also older housing that needs to be demolished. So I think we have a year's worth of fundamental supply for housing units, which includes both single family, or what's this called, 1 to 4 door residential. And then on the multifamily front, of course, that exists too. And all real estate is local. So markets that have been oversupplied, there may be a little disbalance there. But in general, the years of fundamental demand growth, which should mean multifamily is a good asset class, providing hedge against inflation and just providing steady income growth. Of course, we're dealing with the inflationary pressures. This whole insurance industry cartel that's pushed the rates up on everyone is a little obscene. But we're dealing with these fundamental changes in some portion of the business, while the other ones are just great. You know, I don't see major issues in the multifamily industry in general. In fact, what COVID has given us is the opportunity to work remotely. That remote work has been developed to the nth level. The whole Tempo team, we have no physical office. Everyone works remotely, and it can be done, and we've done it for many years. So other companies take a little different approach, but overall, multifamily, people want to live where there are good schools, good areas, good shopping, good experience. I think we're going to see that shift continue as long as remote work continues to be an acceptable way to do business. So that's my 2 cents. And then, of course, again, interest rates impact us a lot. It's not just the interest rates, but it's bank credit. I think, Rob, you talked about that. The bank credit availability is incredibly tight right now. So we're dealing with effectively very depressed market conditions from the availability of financing, and things can actually get better from here. We don't know when, but things are so tight that it feels like we are hitting the bottom of the market. I don't know if it's the bottom, but it's kind of, from the credit side, it feels like it can't get any tighter. So
well, back to multifamily. Back to multifamily. Let Bruce talk. We're gonna need to keep on time here. We'll get into those questions later, Mike.
Well, you know, the original question was about transition of population due to remote work and things like that. And we definitely saw that. You know, people were going where they wanted to be because they could work online. Elkhorn, we're really focused on workforce housing. A very low percentage of those are able to work from home, and so our tenant base is really not as transitory and doesn't have the options as other tenants. So we weren't really impacted by that. So that's why I didn't really jump in earlier on it. But we definitely see it at the upper end of the market. You know, your Class A is going to be impacted by that, an event like that, where, you know, would you rather be looking at the beach or, you know, the inner urban? And probably a beach or mountains, you know.
There's a lot of working class by the beach, at least in Florida.
There are a lot of those pretty areas where they need more workforce housing.
Yes, sure. Yes. Well, going on to storage, I want to know if you guys have seen the growth across different regions and what factors are driving the success of storage in this year.
Scott, let's toss the football back and forth here. You want to start?
No, I don't want to, you know, just, you shouldn't be penalized just because your last name starts with a V. So I will concede the floor to VanWest Partners. It's yours, Jake.
All right. Well, I'll be an easy act to follow, I can assure you. We saw, as many of us listening right now, we saw historic consumer demand increases in the years following COVID, really late 2021 and early 22. Not all the operators, but almost all the operators, the REITs, the smaller folks, were reporting record NOI growth, occupancy growth, as people were shifting to work from home. They were clearing out their third bedrooms. They need a storage solution. We saw, which is getting more clear as the rearview mirror gets more distant, we saw what we think is a trough in consumer demand in probably Q3 and Q4 of 23. And we're seeing that climb back up here in Q1, especially in March. We've had pretty explosive occupancy growth month to date in March, which is encouraging. But there's some markets with some supply shock, just like any real estate investment strategy. There's certain markets that have a a lot of new inventory coming online. There's many other markets that have a lack of inventory. I would say the poster child currently right now is Phoenix. Phoenix has a ton of new supply coming online. It's easier to get deals entitled down there. We're already seeing declines in street rates there and physical occupancy growth. But one of the advantages of storage from an operator perspective, and I'll hand the baton to you, Scott, after this, but our leases are all month to month, so we can respond real time to supply and demand changes. So if we have a unit type that say is really full, we can raise rates on those customers with a 30-day notice. And likewise, if we have a unit type that's suffering, we can drop our rates below market and fill those up and eventually start increasing rates over time. So you can respond. The revenue management is very dynamic. If there's a supply shock or even a consumer demand boom, you can respond with your revenue management kind of real time to extract more value out of your portfolio. But I think the risks in storage now really are outside of the fundamental real estate risks like interest rates, cap rates, rents. I think the risks are just quantifying the risk of new supply, which I think is becoming more muted. It's really tough to build right now from a capital perspective, from a debt and equity perspective, and even from an entitlement perspective. So I think there's a good story for muted new supply. But certain markets you got to be cautious in for sure. Scott?
Yeah, ditto. Next. We're from what Jake mentioned, yeah, we're very fortunate to be in the storage game during COVID. We benefited very greatly for the reasons he just mentioned. But we're also in storage. We're in the trauma and transition business, and so anytime there's a trauma in the economy or in the market, it causes a need for businesses to put their things in storage as they reduce, and the same thing for individuals. But we also follow the housing market, and so when people, that's the transition side, and so when people aren't moving, when they're not buying a larger house or refinancing and buying a second house, that vacation home that they've been planning to buy, all those movements in the economy necessitates a need for storage. And so when we have a lack of activity on the housing side, and that's multifamily and single family, just if people just aren't moving, then we don't have as much of a demand for storage. And so that has affected some budgets. It's affected some projections, and I feel, going back to Jake's comment as well, we see that if people just aren't minding the fundamentals of real estate, and that means, looking into what's happening in the market at the time, no longer, if I put anything in front of Mike right now, Mike Zlotnik, that it has a 3% rent growth linear for the next 5 years on our project or our fund, and a 2% revenue or expense growth, he's going to shoot that back pretty quickly. And so we've gotten a lot better and have to determine what's going to happen next month, what's going to happen in the next 6 months. How is supply affecting that, and the folks that are going to win and be successful, to answer the question of the folks that are really minding all those things. And just kind of going back to what we said before, there's a lot of folks that are going into the Sunshine States, the Smile States, and that is attractive, as Bruce mentioned. But as Ken said, that there are some areas that now are, some of these folks got a little overzealous, and the zoning boards granted them approval, and they should have been a little more self-policing, or those markets and those municipalities probably should have governed those a little bit more closely, so they didn't end up in the position that we're in. But once you get down the path, and some of these developers have raised the capital, they have no other option other than to move forward and then maybe adjust projections on the back end, and that's one good recipe for being not successful or as successful. So it's minding your store, it's doing the due diligence, and just making sure that you're on top of everything. There's no such thing as a static financial analysis and underwriting and projections in today's market.
Let me make one more succinct comment here on what rents have done in rates. So in self-storage, there are two kind of jargon terms to use as it relates to rents. One is street rates. Street rates are the advertised online rates that operators are marketing their unit to lease for. And then there are achieved rates, and achieved rates are what they're actually achieving in rent. So what's been happening the last few quarters is the large REITs like Extra Space, CubeSmart, and Public have been implementing historic move-in concessions higher than they've ever done before. So if you're looking at what rents have done through the lens of just street rates, you're seeing in many markets a major decline year over year in street rates. But what you're not seeing are the achieved rates. So what the REITs are doing is they're offering more substantive move-in concessions to their customers to get them into the door. And again, we're month-to-month leases. But then what they're doing is they're more rapidly moving that customer up to market rates. So many customers will see like a 50% increase in their rent after being there for 3 months. So in a lot of markets that we're in, you'll see maybe a 40 or 50% decline in street rates from peak to trough, but you'll see an increase in achieved rates by maybe 25%. So it's kind of two sides to the coin there. And from the position of the operator and a property manager, which we are, it's made forecasting and revenue management more challenging because you're looking at market rents and street rates, and you can't really find out what they're actually achieving unless you go talk to the on-site and mix it up and try to get them to say something they shouldn't probably. But we've gotten our arms around it pretty well on what's happening. But that's been one big scratcher in the storage space, head scratcher is, man, what are these REITs doing? Well, here's what they're doing. Yeah, they're giving away the unit to move in, but then they're jacking you up to market rates much faster than they have historically.
Well, let's move on to retail. Retail has undergone significant transformations recently. And Rob, you kind of touched on that earlier about how it was the redheaded stepchild in commercial real estate, basically. But what strategies should retail real estate investors employ to navigate the challenges and opportunities in 2024?
Right. So I guess what I would start off by saying is that I don't actually believe that retail has gone through such a major transformation. I think that investor sentiment has gone through a transformation. We are buying kind of bread and butter, kind of best in class retail in good submarkets with the right demos and all the things that make retail work. 5-7 years ago when we were buying and raising capital, a lot of people kind of paused at our strategy and said they thought, e-commerce was going to put brick and mortar retail out of business. I think, COVID really kind of helped solidify our thesis that was just not true. Retail has been actually pretty steady since we started investing in it 8 or so years ago from an operations perspective. In fact, today our leasing momentum is extremely strong, and it's been very strong for the past few years. I mean, certainly e-commerce has changed how retail operates. I don't want to certainly sound naive about that. I mean, there are certainly new concepts today, more concepts around healthcare, entertainment. But if you buy kind of open air shopping centers in good markets, and one of the things we like about retail is that it's a real kind of high barrier to entry business. It takes people, it takes expertise, it takes relationships. You have to know the brokers, you have to know the tenants. You have to really work it on a day-to-day basis. And so not everybody can successfully get into retail. And we find that, kind of a real benefit to, guys like us who have that infrastructure and those relationships in place. The other thing I'll mention, a lot of people are talking about different supply-demand dynamics. One of the interesting things about retail is that there's been almost no new supply added since the great financial crisis. And it really is, if you look at the statistics since 2009, almost no new retail has come online. There's been a little bit here in some mixed use or some kind of small product like along the street, but really very little has been developed. And in fact, you're seeing some of the worst malls, kind of the C and D malls have gone away. So you've seen a reduction in retail and a consolidation into the better product. So, and then if you're buying in good submarkets where there's strong graphics and population growth, you have a great dynamic of increasing demand and a reduction in supply. The other thing
Rob, on that point, I just wanted to ask you, obviously, I think on the retail side, it's been more of a demand issue in the sense that, all the competition from online retailing taking share. At what point do you see that not really being a factor, or really the supply demand is so much in favor of the supply that really now it puts the floor under things from that long-term secular headwind perspective?
Right. I mean, we're already seeing that. I mean, our portfolio is about 94-95% leased today. So it's basically at full occupancy. And I think that's actually somewhat consistent throughout, throughout the business in total, outside of our portfolio in particular. It's really interesting. The better, a lot of our better tenants are the public companies like the TJ Maxx's of the world, and and the Krogers and the Publixes and guys like that, or companies like that. There's significant demand for them to grow. They want to grow. Their businesses are doing well. Profitability is strong. And so what we're finding is that there's a great opportunity for us to fill any vacancies, and we actually don't have a lot of vacancies in our portfolio today. And when we are filling them, we can push rents and negotiate the right leases for ourselves. The statistics I see is that e-commerce has really flattened out already, kind of in the kind of 17, 18% of total retail sales today, and it has not increased over the past couple of years. In fact, there's been a little bit of a dip. Another thing that we're seeing in the e-commerce world, that it's very, very difficult to be profitable in e-commerce. In fact, even if you look at Amazon's financials, where they really make their money is in web services and other areas. They don't really make money as an e-commerce company. And that's why you're seeing a lot of these pure e-commerce companies actually open stores and are opening brick and mortar locations so they can actually make money, because it's almost impossible to make money as a pure e-commerce company. The other thing I'll add is that a lot of been discussion around cost inflation, which I brought up earlier, which has been significant. One of the nice things about retail, at least the retail that we own, is that most of our leases are triple net. So the tenants are the ones that are paying for the increase in costs. We are not, and so it does not impact our bottom line in the most part. Not all of our leases, but 95% of our leases are pure triple net. So if you see increases in taxes, insurance, and common area maintenance charges, those are impacting the retailers themselves. Our bottom line does not get impacted by that. So just a few kind of thoughts around investing in retail today.
Thanks, Rob. Keeping in time, I just want to keep on the subject of e-commerce and go into industrial. I know Mike and I do industrial type investments, and so I'm going to ask Mike, what are the prospects for industrial real estate in 2024? Where do you see the greatest opportunities for growth? Like which market? And I want to keep this answer real short so we can move on to the next topic. If there's anyone else that wants to chime in, please let me know. Raise your hand and I'll let you.
Yeah, I'll go very short and don't claim to be an expert in industrial. So what I've seen is in the, let's just call them the hubs, where the transportation moves through. Further development on sort of warehouses continues. But in big cities, there's a lot of repositioning potential for some of these office buildings that are just not functioning as office. And some of the recent articles and discussions that I've heard is, can some of these buildings be reused as data centers? So the conversion of office to multifamily is super hard. The conversion of office to some kind of industrial use or related can become an interesting opportunity. So depending on the area, depending on the city, opportunities are very, very different. And the general investment climate for industrial, especially the large projects with triple net tenants, one gigantic tenant, let's just call it an Amazon or one of the distribution centers, those are case by case basis. So new development is attractive where the new technologies can be implemented. The same concept as some of the old retail can be repositioned into pickleball courts, etc. But the newly developed pickleball courts are more attractive. As crazy as it sounds, I know, Rob, it's your territory, but some of the discussions that take place, and the same is true, by the way, in the office space. Why the new Class A properties are doing well, while the older product is struggling. So again, custom built opportunities of buildings, industrials that serve specific client needs continue to be the opportunity to go, because basically you are investing in a pre-purchased asset where there is a tenant that's ready to sign, and I see these opportunities as a safety play. And then the big opportunity play for the next 10 years could be repositioning some of these office buildings into potentially industrial, even storage or data centers in big cities.
So which markets do you see being like the biggest opportunities for those?
I don't have a specific market. This is a very developing and discovering sort of evolving type of opportunity. I would say big cities that have a lot of dysfunctional office have a significant need to redevelop. So it's
Okay.
real estate where the location is great, but the current use is difficult. I see really interesting opportunities there, but typically those projects are large investments, and they need significant state and city and federal incentives to move forward. So that's my 2 cents.
Thanks. How do you, this is for anybody who wants to answer first. How do you anticipate AI will reshape real estate in 2024, and particularly the terms of investment strategies and market analysis? Does anybody have any speculation?
How many
I think
hours do we have?
I
We've
think
got-
in short, it's depending on which tools you're using, right? It's a variety of different AI tools, right? If you're just talking
Right.
about ChatGPT, it's tough because it's still years behind of current data. So it definitely helps makes things more efficient for analysis. I think it's a game changer. I mean, I don't think anyone on this call would think different. It makes all of our lives easier. Trust but verify is important when you're using it. But it's been great for us in helping us see things we wouldn't have seen or get things done faster that would have taken a little bit longer. So it's almost scary, right? We use it a lot. So we're just embracing it and just being mindful that the biggest part you have to understand is that it's open source. So you have to be careful what you put in there, right? Because it's open to the public. So it definitely allows you to help with marketing and other stuff. But as far as analysis and due diligence, there's still a lot of manual things that we're doing that AI won't see that we can see or feel or be able to do from a human aspect.
Yeah, I totally agree with that. I use AI every day for a lot of things, but it is not perfect. It's not a human, where we know things that it just assumes a lot of things. So anybody else wanted to chime in on that? No.
I mean, we're not using it for anything sexy like acquisitions, and I don't think I probably ever will. But I just, because it's so dependent on the people that created it and their views and how that could skew things. But we're using it on something as mundane as service, and so people submit a work order, and we have AI functions that help prioritize and route that depending on what it is, which really does help make sure that the real problems get addressed immediately.
Yeah, that's what I wanted to say just real quick, is I think you're going to see AI across a whole range of tools. And what I see coming, which will impact real estate, but it's a kind of indirect impact, is that I actually gave a presentation about 4 or 5 months ago in Dubai that I think AI is going to be very significant enhancer of productivity across the global economy across the next few decades. And if that turns out to be true and the productivity goes up by X% per year more, that's actually going to create a lot of wealth and a lot of opportunity across the whole economy.
Well, let's move on to what key risks and challenges we're facing in 2024 and how to mitigate and ensure suitable growth. I know that we've talked on interest rates and insurance and taxes. Cost of supplies is starting to go down. So I think it really depends on your source or your location. Does anybody want to chime in on this?
Yeah, I mean, I know we've talked about rates and people have mentioned, hey, we don't know where they're going to go, but they're just simplifying it way down. There are 2 things that can happen. They can keep rates where they are, or they can cut them. And so if you walk that forward, the rate increase that happened so rapidly, I think Jacob and Mike or Scott, someone was saying it was affecting supply. I mean, if you weren't sticks up on a new development prior to the rate hikes, it probably hasn't happened in the last couple of years. Well, that has a supply impact down the road. There's going to be a supply gap of housing. And as somebody mentioned, we have a gap of needed housing already. And so that's inflationary. But if the Fed keeps rates high, it will affect some deals. It will make some deals bust and things like that. But the magnitude of their own debt position is, it's $35 trillion, far outweighs the deflationary impact of the real estate that it'll have, because what's going to happen is they're at 35 trillion. Their interest expense is already more than doubled to 1.2 trillion, which is more than we spend on all of the funds. And so they'll have to print money in order to keep paying interest on the debt if they keep rates high. That's inflationary. So if you take the other path and cut rates, what happens? Well, then you get inflation from asset price increases, because deals start happening more. You need less equity because your debt service coverage ratios go down, things like that, and that'll force asset pricing up. So I don't really see a path where there's not going to be significant inflation either way, whether rates stay high or they cut them. And I think that drives pretty much everything, whether it's retail, storage, which I am jealous of Scott not having to deal with all the tenant issues we deal with. Retail, industrial, whatever it is.
I want to ask Scott particularly, what advice would you give new investors entering the real estate market in 2024? There's several people that have submitted questions before this, and I'll go over those in just a minute, but I wanted to get everybody's perspective on this particular question about new investors entering real estate market in 2024. What critical pieces of advice would you offer to help them navigate the landscape and make more informed decisions?
Yeah, the same as we've been stating for the past 20 years in our education organization, which is make sure that you understand the market that you're entering and whatever asset class that is. You need to get very well educated, not only on the asset class, but also truly the market that you're entering into. And depending on how sophisticated you're looking to get, there's lots of tools and lots of data to find on a single family house if you're looking to get comps and how much it's going to cost to be able to rehab a house and do whatever you want to do with it afterwards. But when you get into looking to commercial real estate with more commas and zeros, you really should get not only consultants, but a mentor or a partner, preferably somebody who is already in the asset class to come alongside of you and partner with you, or you partner with them on the first one, so you get a good look at it. Also, this is not self-serving by any means, but there's many of us that raise private equity and many folks that come to us, all of us collectively on this call, and they're investing, the minimum amount to be part of our fund to invest in the asset class and earn while they learn. And so, by way of the financials that we send across, the due diligence materials that we make available in our portal, and then the regular meetings that we have on a regular basis, they can learn about the industry. And then when it comes time to do their own, go back out into the marketplace with everything they've learned and go to lenders and private equity partners as an owner, because they did have a fractional ownership in a self-storage facility or in a multifamily project when they begin to go and ask for capital. So if anything, just to dial it back, educate, train yourself. Don't assume that you're going to go out and be a self-made man or woman in any asset class. You need to eat a little humble pie and come alongside of somebody, or have them come alongside of you on the first one.
Good advice.
I think that's great advice.
Rob, what are your thoughts?
I certainly agree with everything that Scott said. The only, I guess, what I would say is, and I think Scott actually did say this at the beginning of his comments, that whether it's 24 or 5 years ago, 10 years ago, I think it's the same advice. I don't think it changes by market. I would say that from my perspective, the sponsor is the most important thing. I think actually somebody else said this earlier, that kind of pick the jockey, not necessarily the horse. I do feel that in all markets there'll be opportunities in 24 and beyond. Everybody's down in office. Somebody's going to figure out how to make a lot of money on office, right? As an example, I'm not an expert in office, so I'm not playing in that space, but somebody's going to figure out how to manage through some of the the structural issues around office. So I think there's going to be opportunities in all sectors. I think it's just finding the right partner to go with in those sectors. I agree with Scott that you need to be educated, understand what you're investing in, kind of dig as hard as you can, ask as many questions as you can, understand the sponsor that you're working with, make sure that they are the real experts in that field. They've been in that field for years and understand all the ins and outs, and I think they'll do well. So kind of just adding on to what Scott said.
Does anybody else have any advice? I think Fuquan, I'd like to hear from you.
Yeah, so it's really the track record of the person that you're investing with that it all boils down to, right? You can and the person actually, right? Who's the sponsor? Are they going to stand tall when things go wrong, right? Or are they just going to stick their peacock feathers out when the wind is in their back? The track record the person have, you know, understanding the investment, know, like, and trust, speaks in volumes. A lot of investments that I am involved in as a passive investor is specific questions you have, right? The succession questions and what happens if you get hit by Amazon bus and all those other great things, right? And understanding the risk that's involved. You can lose your money. You can lose all of it. And going in with that mindset of understanding makes a better investor, right? So educating yourself, as they mentioned earlier, and knowing the sponsor and the track record speaks volumes. So, you know, that's what I have to say about that. Everything else is basic, right?
You have anything to add, Ken?
Yeah, I just one thing that real estate over longer periods of time is a cyclical thing, and like lots of things have cycles. And so I would encourage people, especially people starting out, but just really everybody, to always be long-term in their thinking and their actions. Like, don't just do something and then expect it to work right away and get discouraged if it doesn't. You know, if your first thing you do has some challenges, you know, you have to put your big boy pants on or big girl pants, depending on who you are. And I think if you do something like real estate, or you know, I also operate, as I mentioned, in the stock market, and you do it with sound fundamentals, and then you stick to it and learn, and you do it for the long term and patiently, it just tends to work out quite well. So just be long term and do your homework, and obviously do it with good people.
Thank you. Is there anyone else?
But a couple of quick comments, and so all this stuff said is just awesome, and that's why you're all here, right? Many of you people I've known for many years. Bruce, again, we have a new relationship, but everyone else is here is a super long relationship, and again, we're grateful for Bruce. For you to come on board, you come, highly recommended. So I'll just say this: obviously, investing business is investing. Number one, it's know, like, and trust who you're investing with. Fuquan said. There are situations where things don't go the way you plan, and how people manage. You learn more about people when they manage difficulties versus when they are managing great successes. So obviously, picking who you invest with carefully. As Ken said, don't get discouraged sometimes when you start and things run into a challenge here and there. As long as the fundamentals are solid, in the long run, real estate is a great asset class. And then remember diversification. Diversification is many elements. That's why this group has specialists in multifamily, open air shopping or retail, self-storage, nodes, and ground up development, and other concepts and strategies. Just be mindful that there isn't one panacea, one solution, a perfect strategy, or perfect location. If you diversify, at least you spread the risk into many strategies, many operators, many locations, and diversify in time. One of the lessons learned, it's very difficult to catch the peak of the market or the bottom of the market. You don't know when it happens. That's why investing over time is the way to go. And of course, be prepared that the investment is not going to go perfectly. It's one of the most difficult lessons learned is a lot of projections. And one of you guys alluded at the very beginning, be very careful with these optimistic projections. Whatever you hear, always adjust for risk. Have some number in your head where something can go wrong, and adjust for risk. Prepare for this on a long-term basis. Real estate is just a phenomenal asset class, but patience and prudent diversification, including the time, is the way to go. That's my final thoughts.
Bruce, you've unmuted. Oh, okay. You muted yourself. You don't want to chime in? We can't hear you on mute.
Yeah, I think it's great advice. You have to diversify, be careful about the risks. There's so many people that do invest that don't take into account what could go wrong. Like, you know, for example, hurricanes causing insurance to go up and things like that. They just assume that the party's always going to keep going, and it never does. But real estate is a long-term asset class, no matter how you express that, with the subcategory of whether it's retail, you know, multifamily, whatever it is. And it's a great place to be if done correctly by the right operator, but you have to be very careful what operators you work with. It's not just about having a presence online.
Thank you. Jake, you've unmuted.
Yeah, real estate's a great wealth creation strategy, but it's a slow wealth creation strategy. It does not happen quickly. So whether you're investing with a sponsor or doing your own direct deal, have patience.
Awesome. Yes, that's a very good point. I want to bring up the last question and very quickly answer it before we go on to answering the questions from the audience. Looking beyond 2024, what long-term trends in real estate should investors be preparing for right now? I know we're talking about interest rates being higher, insurance being higher, taxes.
Mike
do they
seems to
ever
have
go-
the most. Mike's crystal ball seems to be the one that has been the most accurate recently that we've heard, and so maybe we should just defer to Mike because I have nothing to add to that, nor do I dare to go out onto that branch.
Well, I'll venture, thank you, Scott, into crystal ball discussion on just a couple of quick comments. So obviously, preparing for possibilities is the way to go. We don't know exactly what's going to be leading, but I'll tell you this again, Bruce, you mentioned this. You mentioned two possibilities. I see three possibilities in the comments to the interest rates. There are only three paths I see, and I'll just kind of shoot them out. One called stagflation, two I call it soft landing, and then three I call it recession. So depending on how things will play out, the Fed will act accordingly. Right now, it will look like a middle of the road soft landing. But if we see a spike in inflation and slowing economic growth, we're going to be in the stagflation environment, the worst of them all. So it's a possibility and something we need to keep in mind. The only good news was stagflation periods don't last. The soft landing and slow action by Fed, I'll add this comment. Many of you have heard me speak. Fed is not in the preventive medicine business, they're an emergency room business. So when the patient appears to be sick, they act. Right now, the patient doesn't appear to be sick, and the inflation appears to be a great aggravation for them. So I would expect this very slow environment, and we'll see what politicians do. This is one big unpredictable element. Politicians can spend. It's a sport that they love, but there is at least balanced Congress, and the hope here is that there's going to be some sanity to this insanity. And then I'll add one more possibility. If recession hits for all of us in real estate, recession would be a technical recession, a welcome news. I hate to put it this way. I would like something else to break in the economy so it gives Fed an opportunity to cut interest rates to deal with that problem. That would be welcome news for us. So that's my couple of cents on the what the Fed does. And then as far as other trends, yes, we are dealing with periods of extended budget deficits, but we don't know how they're going to solve with it. Either they're going to print cause inflation, or they're actually going to force to cut the rates. I'll add one more comment and then I'll shut up. The fact that the interest rates are higher is not necessarily fighting inflation. That's the crazy part. High interest rates means higher payments on bonds. It's actually transferring more dollars into the people's hands. So what used to work by jacking up interest rates, you would fight inflation. It is not necessarily fighting inflation. It's fighting inflation on one front. On the other front, it's actually providing more income to the bondholders, and they go spend the money. So some really interesting side effects that they don't even know. But on a long-term basis, the interest rates at the current level, in my view, are not sustainable given the size of the debt and the budget deficits. So long-term view of the interest rates will eventually come down to a more reasonable level. Unless, of course, we wind up in a Zimbabwe where you have to buy lunch and pay for lunch before you get the food. Hopefully not. So,
Is there anyone else who wanted to comment, or else we'll go into the questions?
Yeah, I could go all day about government debt, but no one would want to listen to it. But I totally agree with Mike, and maybe we can have a different conversation about that on your show.
All right, let's jump into questions then. I got a lot submitted before the event, and I did see some questions in the live audience that are very particularly to their specific single family investments. And so we'll probably not be able to give you a good answer on those questions, just letting you know, this is more about the commercial real estate industry. But we've covered a lot of the things that we're seeing in the industry about increases in costs and inflation. So I want to go on to different questions that I think would be valuable for the audience. And so what opportunities are there if interest rates stay elevated longer is one of the good questions I saw.
And I think, as I said before, I think there's going to be opportunities in all sectors. I think you just have to be careful with in any interest rate environment. You have to, make sure you're buying good real estate. Most importantly, in the right markets, and structure it properly. So, the right level of debt, conservatively, fixed rate, in my view. So capitalize it well and conservatively, but whether we're in a higher interest rate environment or a lower interest rate environment, from my perspective, our underwriting process has not changed at all. We certainly use slightly different inputs, but we're capitalizing our assets conservatively. We're buying good real estate in good markets and operating it as efficiently and as effectively as we can. And whether the 10 years at 4.5% or 2.5% doesn't really impact how we do that.
If you had $250,000 to invest, what specific U.S. region and asset class would you invest in? That kind of goes hand in hand, where there's going to be opportunities everywhere in different sectors. So it really is about your research, what you feel more comfortable in. So how to identify a secondary market that is the right market to get in is the real question I would like to ask.
Yeah, I would. I'll jump on that one. I mean, we just approach it very quantitatively. You don't want to be emotional about it. You don't want to restrict yourself to just where you live. Let's say, I mean, I won't pick on any town or particular towns, but there could be a town that you're familiar with, and it may not be the best place to be investing, but you start investing there just because it's what you know. I think you have to look at the basic things that drive demand and supply. What's going on economically in that region. Is there a population migration in or out? What is there job growth? Is there industry diversification? All those things are very important to us, and it helps us quantitatively and unemotionally target top markets for our investments. So I think that's important for anybody to do, because if you've done that work, then it's gonna keep you out of it's at least going to keep you in the flow with the trend, a positive trend.
Are there good opportunities for depreciation acceleration in 2024?
Well, let me take that question. Let's see what the Congress does, right? So the Congress is entertaining a possibility of extending, even backdating the depreciation for the last year to be 100% bonus to come back. So if that bill passes, we're going to be back to 100% bonus, including 2023 possibility of 100% bonus. So that is a mechanical element that will help substantially. The second component of that, obviously, is going to be fundamental real estate purchases. So everyone here is looking for great deals. Once they find a great deal, you can apply cost segregation with bonus depreciation strategy. You could structure the capital stack with preferred common equity and create some outsized depreciation through financial engineering. But don't forget the most important element: fundamental, strong investment. So if the investment is great, then you can do bonus, all that stuff that we just discussed, bonus depreciation. So the opportunity is there. It looks like the bill may pass. So we may get back into the later part of the year where a ton of great deals will get all that support, and we might wind up helping investors from that perspective.
I've got some real good crystal ball questions, but I want to hear other people's perspective on them. And I also, some of these questions are really good. I just don't know the answer, so I want to hear others. What is the safest sector to get into? Does anybody know that answer?
I'll respond. Diversify. That's the safest strategy. If you don't diversify, you don't know. The crazy part, I add one comment. You don't know what's going to be a home run, it's going to be a striked out. We've seen this again and again and again. Deals that look like a massive home run wind up being a problem, a difficulty, and a challenge. And the reverse, the really boring, very non-exciting strategy, maybe in a boring market with self-storage, winds up getting us a great return. Or open air shopping plaza. We just don't know. That's my 2 cents. Don't try to guess the markets. Don't try to be the smartest cat out there. Be prudent when you apply diversification. That's my 2 cents.
If you're an active investor, once again, we've kind of beat down the fundamentals of what it takes to get into a successful deal, and I think you could get into a lot of trouble, or you could hit a grand slam home run, no matter what market you're in. Being a market agnostic, either you're really good and you're going to do well, or you decide to not do your homework. If we're talking from the passive investing side, any head of a family office and most passive investors will tell you that they bet more on the jockey than they do on the horse. So it's not about the asset class, it's about picking a solid company and or fund or individual that you partner with. And so I don't know if the person who asked that question is looking to invest passively, but if that is the case, look for somebody who's got a company who's got a strong track record over 2 recessions, at least 1, if not 2, and that has done well. Those are the folks you should be investing with.
If we've closely, if we've been going down in this industry as a whole, what are you using for your stress test now? What's your base case? What's your extremes that you're going off of, since we're supposedly lower than 2008? I see some strange faces, but this is the kinds of questions I'm being asked.
I think we might need some clarification on that.
So I guess, what are specific metrics you're using to do stress testing on your portfolio?
I mean, again, I'll say in the retail world, again, the analyses that we do not really change significantly with where we are in kind of the current credit, interest rate, economic environment. We're analyzing the quality of the real estate the same way. And so, I mean, retail is obviously going to be different than what the other maybe folks on this call are going to mention about multifamily or self-storage or others, industrial, et cetera. In the retail space, we're always analyzing our ability to backfill space. There are specific things that make real estate work or make retail work in my world. There's good real estate and there's bad real estate. There's good retail and there's bad retail. And we know what that is. We know what it looks like. It has certain components to it, whether it be ingress and egress, the size of the boxes and visibility from the street, and certain types of demographics we look at, and our ability to what we call voids in the market, what retailers are missing from a market. We look at all of that and our ability to therefore deal with downside. I don't believe do anything where we have an unmanageable risk within an asset where it's cliff risk and we just can't deal with it. So everything we try to assess is based on the fact that we believe we have assets where we can manage that risk, and the question is, what's the cost of that management? What's it do to returns?
Yeah, I think it's against which risk. Stress test against what? Are we stress testing against interest rates, occupancy, rental rate? They're all different things that you can stress test, and you should, but it's hard to stress test every variable to the downside at the same time because nothing would ever work. And so there is risk to investing. But the thing with real estate is, everybody has always said, is just the ability to hold on. And so key thing to look at is make sure that the plans are conservative. And then I think, as Mike said, is make sure there are reserves. And so, if you have reserves, because insurance, a lot of people talk about insurance going up. We're actually seeing it go down right now. But that's brand new right now, real time. And insurance goes in cycles. The insurance companies take a bunch of losses, they jack up rates. They keep pushing them, and then it gets really rich for them for a period of time. They lost margins, and the new participants come back in and it forces pricing back down. And so it's just ability to hold long term on the assets. And if you underwrite something to perfection with no reserves, you know, if you get lucky, it'll work, and if you don't, you're going to lose everything. So you just need to be more conservative and maintain reserves and all.
I'll add one quick comment on this, just a one quick comment. There's no right or wrong metrics. Like Bruce said, you don't know what to stress. So the common exercise in the industry is to use sensitivity analysis. You basically you have many variables as part of your underwriting, and you move them up and down. So sensitivity could be in relation to the interest rates, cap rates, rent growth, many other factors. And the other thing that to keep in mind, we just seen a black swan event. We just seen COVID hit, which is a black swan event that hasn't happened in a long time. We don't know when the next black swan will hit. So some of the underwriting, you can't prepare for every possible black swan. Somebody can drop a nuclear bomb on a city. You know, who knows? It's crazy stuff that can happen. So all these things are not going to be your normal underwriting conditions. We basically prepare for a 100-year-old flood. And then the 150-year-old flood happens when the Fed move rates up so fast and furious. So these conditions can happen, but in general, again, having reasonable assumptions and having a buffer, a margin of safety of some level is necessary. And as Scott said, it's the jockey. You're not really betting on a given project or given horse, but you are putting your money on a jockey and their ability to deal with problems, solve problems, and continue to move forward. So that's my 2 cents. Some level of safety is required, but you can't predict for every possibility that can happen out there.
I know we're getting way past the time that we allotted for this meeting. Thank you all for staying on. I want to just real quickly go around the circle and tell us what your prediction is of when interest rates will come down, or if you think they're going to go up, or what do you think? Starting with Jake.
All wrong here, but interest rates have peaked, and we're going to see a federal funds rate by the end of the year that's gone down by 50 to 75 basis points.
Ken. Can't hear you. You're on mute.
I agree with Jake. I would have said the exact same thing.
Rob, you're nodding. Do you agree with that one?
I agree. I'd say 50 basis points. I always felt that it was going to take a little bit longer to get there. The whole idea of 5 or so cuts this year, I thought was not going to happen. So I agree. I think it's going to be kind of later in the year, and 225 basis point cuts makes sense to me.
Bruce, Scott?
Yeah, I mean, a lot of experts think that the Fed's going to want to avoid doing it right before the election, so they're not viewed as political. So they should probably need to move by maybe June. If that's the case, I do think it's not there are not as many cuts as what was in the expectations of many analysts out there. I think 5 or 6 is just way too much, unless they break something like the banking system again. I mean, arguably they've broken commercial real estate in many places, but those deals are yet to bubble up. So I would say hopefully 50 basis points in the current year.
Yeah, I would agree. 2 or 3 guys that I listen to, and they'll tell us what's going to happen a couple of days before the vote, and usually that's what comes out. And then at the end of the day, we can only do what we can do. So no sense predicting. We just work with what we've got afterwards.
Yeah,
Mikey?
I'll add just a little bit more bullish, just a tiny bit, and I'll take the risk. Of course, there's almost no upside in doing this. So I'll say 75.
Mike, just remember, Jacob's going to record this and regurgitate it to you in 6 months. So careful there.
I will push to 75 to 100 basis points, even though it's an unlikely scenario. And the reason for this is I think something's going to break. That's my 2 cents. So it's going to be that scenario, and I will be wrong. So I'll put a disclaimer that I'm taking a little bit more optimistic view, but it's a low probability projection. So remember, everything has like a risk has likelihood and impact. Likelihood of this is a little bit lower, but the impact would be greater. So I'll take that position, 75 to 100 basis points.
It's on the calendar.
Sorry, what?
It's on the calendar, Big Mike.
I just think it's funny that Mike said that his optimistic, and his optimism is that something breaks. But,
Yeah, exactly. I was thinking that myself.
I hate to put it this way, but I said it before and I'll say it again. I'm sorry to say this, but our industry has been heavily impacted by higher for longer rates. Plenty of other industries have not, and something will break. The banking system is obviously completely in control of the regulators and the Fed and so on. But there are significant forces in the industry that are undermining this move, this soft landing. And it feels like even though it's an election year, something will come up. So that's as far as I'll go, but it's probably, 1 in 4 chances of that happening. So that's my 2 cents.
Well, thank you all for attending. I appreciate your time. I know we've gone over quite a bit. We've got a lot of topics we can cover. If you guys want to do this again, we're going to try to plan it for probably around the time you all predicted that these interest rates will be coming down, and we'll see what types of opportunities will be around then, and the challenges that we're facing at that time, because it's always something. Does anybody want to put any last comments in?
Thank you all kindly for coming on this event, both folks who are tuned in, watching and listening, and all of you folks on the panels. Grateful for your time, wisdom, and it's TGIF. Thank God it's Friday. Enjoy the Friday and enjoy the weekend. Thank you all.
Thank you.
Thanks, everyone.